Welcome to the Lockshield Partners Podcast. We believe in financial literacy and love to provide quality information when it comes to areas around financial planning and how it impacts your life. To learn more about what we do and how we serve our clients, visit us at lockshieldpartners.com.
Well, Dan, welcome back. We've got another edition of our Lockshield Partners podcast today. And today we're going to talk about Roth conversions.
We love Roth IRAs, love Roth money.
We do. So, Dan, just to kick us off, maybe we start with a basic review of Roth money, pre-tax money. Perfect. To frame up what a Roth conversion is.
Perfect. Yeah, let me take Roth. I'll take the favorite, then you can take the other one. So Roth just means it's money that's already been taxed. So whether it's a Roth IRA or in your 401k, Roth money means it's taxable the year you contribute it. And then down the road, when you pull it out plus its earnings, there's some rules that you need to follow when you pull it out, but it's all tax-free. That's Roth money.
Then we have pre-tax money or traditional. Those two things mean the same thing, which is the opposite of that. So right. Pre-tax money means when we put that money in, we received a tax deduction for it, or when your employer put it into your retirement plan on your behalf, they took a tax deduction for it. Meaning that when you take it out down the road, it's taxable.
And the earnings.
Which that's the significant part.
If you have years or decades, that could be significant.
For
sure. And there's two main ways to put money into Roth buckets. You can make contributions either to a Roth IRA or in your 401k. Most 401k plans now have the Roth option. Or what we're going to talk about today, you can convert that pre-tax money to Roth money.
Right. So let's start with that. So a conversion in essence, it's pretty straightforward. All we're really doing is shifting money from our pre-existing traditional IRA or pre-tax IRA and shifting it into our Roth IRA.
Pretty straightforward.
Essentially, that's all that we're doing.
We're just telling the IRS, we're running it through the taxable film, screen, whatever you want to call it. Whether it's $1, $10,000, $1 million, that money is taxable now, and then it's tax-free later.
It's tax-free down the road.
Yeah.
And as we've established before, the more flexibility, liquidity, tax-free money that we can have in the long run, the better off we're going to be.
From a financial planning point of view, absolutely.
Right. So the mechanics of that conversion, Dan, how do you do that? How does it go from one account to the other?
Sure. So there has to be documentation, which means you notify the custodian, you go through your 401k or your IRA, your advisor, whatever it might be. Hopefully it's part of an overall financial plan. But you essentially notify them, initiate converting money. The custodian will move the money. If it's in a 401k, you probably don't see any difference in it unless you get to page 2 or 3. But the big difference is the IRS knows. So the mechanics are, I notify my custodian, my advisor, my HR, whoever I go through, tell them what I want to do. They initiate the paperwork. And then that money, the IRS is notified that, hey, I'm converting X amount from pre-tax to Roth.
And just so that we're super clear on this, Dan, for our listeners, when we convert money, the flow of the funds is directly from one IRA to the Roth IRA.
Correct.
And there is no conversion if it goes from the IRA to your checking account.
You don't want
back to the Roth IRA.
Correct. Not in a conversion. That's exactly right.
Right. So straight from one IRA to the Roth. So we've talked about this before on our podcast, Dan, but what we've discussed is there's that 59.5 rule.
Right.
When it comes to distributions from an IRA, we know that if we take funds out prior to that age, there's a tax that's due, there's a penalty that's owed, other than some very unique exceptions to that rule, but generally speaking. So is a conversion different from that? Because there is money coming out of the IRA.
Right. So it is different. There is not the 10% penalty. And the IRS was quick to close a loophole when that first came into play, because savvy tax planners or people would say, well, I'll just convert it, then I'll take it right back out. And the IRS said, no, you won't. So there's a 5 tax year, not 5 calendar year, there's a 5 tax year rule, which says if you convert money, if you take that money out within 5 tax years, it's considered a premature distribution. It's taxable plus the penalty. You'll have the penalty to deal with. I think you will pay taxes the year you convert it. It's the penalty.
Gotcha. So if we use a quick example, so let's say that I want to convert money from my pre-tax IRA to my Roth. $5,000 gets converted. That $5,000 essentially shows up as income when I file my tax return.
Right.
No penalty,
Because
because it went straight from my IRA to my Roth IRA. Great. Easy enough. One thing I would note, Dan, is when that tax shows up, so most custodians will allow you to withhold tax money when you do that conversion, which you can do.
You can do that.
Fine. There is the loss of future compound earnings there.
Right.
So it is a best practice, I think you would agree with this, to try to be able to pay that tax out of pocket.
100%.
Maybe you increase your withholdings throughout the year, or maybe you have some extra money sitting in cash on the sideline, whatever the case may be. If you can work it out to where it's paid out of pocket or through your withholdings, that's certainly a best practice, as opposed to taking 15 or 20% of that conversion and using that to pay your federal income tax.
That's exactly right. And to go into a little more advanced planning, if you run a business, if you're a farmer, if you have a lot of kids, if you are going to have a low taxable income or loss, that would be a great time to do it.
Yeah, that's a perfect segue. So if we're talking about when is the best time,
perfect.
I think you just hit the first one. We want to be able to maximize a Roth conversion in years when we anticipate that our either taxable income would be lower or our tax rate would be lower for some reason. As you've already mentioned, if you're somebody with some income flexibility, self-employment income or a farmer or whatever the case may be, ideally you can time up that conversion with years when you think that your income may be less.
Yeah, that's right. We see with a lot of farmers, because they may have years where they have to spend money, and maybe they need a new truck or fence or barn, but maybe they don't. Well, you can achieve the same thing by converting money to your Roth, and you still have the asset.
Right.
We love that planning technique, especially with farmers.
Perfect.
Perfect.
Another one that you mentioned, Dan, I think that's a great opportunity is younger families, just like mine. If you've got kids at home, most of the time you're going to be able to claim the child tax credit unless you have an extremely high income,
Right.
$400,000 or more.
Right.
When you have children at home with the child tax credit or the dependent care credit, which I will note, those don't compensate you for what kids cost.
Not in financial terms.
But it does lower your tax bill. Right. So that can sometimes create an opportunity. It's not uncommon if somebody's in maybe their 20s or 30s or even early 40s, if they have a smaller rollover, that can be a great opportunity to convert that money. You don't have to convert it all at once. So if you have a rollover of $50,000 or $100,000, you don't have to do that all at one time. But maybe you can spread that out over the period of a few years when you know you have those additional tax credits to take advantage of.
Yeah, that's exactly right. The other wonderful time to do it is a bear market. Bear markets come and go. We've done a podcast on those. From a planning point of view, that's fertile planning time.
Why would that make sense from a timing standpoint?
Yeah, thank you for that softball. So let's go to an extreme example. Well, let's go to a bear market, 20% downturn. So if I wanted to convert $10,000 in my 401k or my IRA to the Roth portion, if the market's down, if my shares are down 20%, now I have 8,000. So I'm paying taxes on a lesser amount. Hopefully I convert it. I pay my taxes on my 8, market rebounds, and I'm in a good spot. The deeper the market drop, the more I would consider shoveling over from pre-tax to Roth, the more I would convert.
More advantageous it becomes.
Sure. And an extreme example of a 50% market decline, which we've seen a couple of times in the last 25 years, that 10 grand is now worth 5. And nobody likes it. Everyone's unhappy, but there are things you can do. You can take advantage of down markets.
Yeah, that's a great point, Dan.
Yeah.
A couple other things here that maybe we can throw out there from a Roth conversion here before we wrap up. So we've talked about the need or the want, the desire for tax-free money down the road. So that's an easy one.
Everybody likes that.
Why else would somebody want to convert shares from pre-tax money to Roth money?
Yeah. Estate planning. Some people who are in a financial position where maybe they've planned, they've accumulated a significant amount of assets, and whether it's from a state tax reduction or just wanting to pass assets onto their heirs tax-free, they can convert chunks, large chunks, pay taxes. It's a big tax bill, but the whole idea is, well, if I pay 10,000, 100,000, 500,000 in taxes, but I can move however many thousands or millions, and maybe that's not all done in 1 year, but part of a comprehensive plan, that can have huge tax savings over decades and generations.
One thing, as we wrap up here, Dan, this could be a good note to close on. So you mentioned somebody performing conversions with large amounts of money. So the IRS limits contributions to a Roth IRA to $7,000 a year in 2024, $8,000 if you're over 50.
Right.
So you're saying that limit does not exist on a conversion.
Yeah, that's correct.
We can convert as much as we want,
As much as you want to pay taxes on,
or as little as we want.
or as little as you want. So someone who has some cash and they have pre-tax assets, they can convert money, pay the taxes out of their cash, and convert a lot of money from pre-tax to Roth.
Good to know. Are there any, other than taxes, are there any other costs associated with a conversion that people need to be aware of?
Sure. Sometimes there's just some custodial fees. Maybe a custodian charges $25 for a conversion
To track the paperwork or the admin
Sure.
or
To
whatever.
send you the 5498 and the 1099R, that kind of stuff.
Gotcha. Let's maybe wrap there, Dan. So
Okay.
every time a conversion's done, anytime money comes out of a retirement account, that's going to trigger a 1099R. So if you convert money, expect to receive that 1099R
Right.
before you file your taxes in the spring. And I think that you would agree with this. Before doing anything like a Roth conversion, always consult with your tax advisor.
Sure.
Be proactive in that. Check with them before you do it. As you mentioned, hopefully that's part of a larger overall financial plan, because there is a balance of, we want to create that tax-free money. We also want to do it when it's tax efficient to do it.
That's exactly right. We're looking for efficiencies, and ultimately we want to be really good stewards of our resources
Absolutely.
and make sure we're maximizing what we can.
Absolutely. If you want more information on Roth conversions, make sure to check out our website at lockshieldpartners.com.